Right, let's talk about a UK tax rule that could genuinely be worth millions to your business. This is a complete guide to tax amortization for the 2025/26 tax year, and it comes to you directly from the brilliant experts at the renowned UK firm My Tax Accountant.
So let's kick things off with a big question. Imagine you've just bought a business for a cool £2 million. It's a massive move. But when you look at what you actually got, the physical stuff, the buildings, the equipment, it's only valued at £500,000. So where did that other £1.5 million go? Is it just gone? Or can you actually get tax relief on it? That is the multi-million-pound question we are going to answer right now.
And here's how we're going to break it all down for you. We'll start with that big question, then get into what amortization actually is. We'll take a quick trip on the tax roller coaster that is goodwill, look at the massive rule change from 2019, and then, this is the best part, we'll run through a real-world example to make it all click. Finally, we'll talk about your next steps.
Okay, first things first. Before we get into the nitty-gritty of saving you some serious cash, we need to be crystal clear on the main idea. So what on earth is amortization?
Well, in the simplest terms, it's a way of spreading out a big cost over time. Instead of your accounts taking a massive hit in 1 year when you buy a valuable asset you can't physically touch, amortization lets you spread that cost out over its useful life. It just gives a much more honest, year-on-year picture of how your business is really doing.
Now, you've definitely heard of depreciation, right? That's for the stuff you can actually kick, like your company van or the office computers. Well, amortization is literally the same idea, but for all the valuable stuff you can't touch. We're talking about things like patents, copyrights, and the really big one we're focusing on today, goodwill. And speaking of goodwill, wow, its tax treatment in the UK has been an absolute roller coaster for businesses over the last decade or so. And honestly, you kind of need to know this backstory to really get why the rules we have now are such a big deal. This timeline really tells the whole story. You see, before 2015, things were pretty simple. You bought a business, you could generally get tax relief on the goodwill. Then, on July 8th, 2015, HMRC just slammed the door shut. Boom. Relief was completely abolished. It was a massive financial headache for anyone buying a business. But stay with me, because that all changed in 2019. And look, this isn't just my interpretation. This quote is from the official guidance. It shows just how sudden and total that 2015 change was. It basically blew a huge hole in tax planning for acquisitions. For almost 4 years, there was just no tax relief at all for goodwill, which made buying a business a whole lot more expensive overnight. But like I said, the game changed again. In April 2019, the government brought back a very specific, very targeted kind of relief. This created a brand new opportunity for smart business acquisitions, and it's the key to what you need to know for the 2025/26 tax year. And here it is, the magic number. The current rules that businesses claim tax relief at a fixed rate of 7.5% per year on the cost of qualifying goodwill. This is a significant benefit that directly reduces your corporation tax bill. But, and you knew there was going to be a but, right? It doesn't apply to every single purchase. You have to qualify. So how do you get in on this? Well, there are 2 key hurdles. First, the goodwill has to be part of a whole business purchase. You can't just buy the goodwill on its own. Second, and listen up because this is the absolute key, that business you're buying must own what's called qualifying intellectual property. We're talking about things like patents, registered designs, copyrights, all the things you see here. No qualifying IP, no tax relief. It's as simple as that. Okay, stay with me because this next part is where a lot of people can trip up. It's a crucial rule called the cap. You see, the amount of goodwill you can claim relief on is limited. The tax relief is calculated on the lower of 2 figures, either the actual cost of the goodwill or 6 times the value of that qualifying IP. Whichever of those 2 numbers is smaller, that's your limit. Let's see how that works with an actual example. Theory is one thing, but let's make this real. Seeing the numbers in action is always the best way to understand the massive impact this rule can have on your company's bottom line. So let's meet Innovate LDN. They're a fictional tech startup based in London. And like a lot of ambitious companies, they've decided the quickest way to grow is to buy a smaller, innovative firm that has some really unique tech. Oh, right, so they've bought the firm for £2.5 million. This table breaks down the deal for us. The physical assets are worth £750,000.
Now, crucially, the business they bought owns patents. That's our qualifying IP, valued at $250,000. That leaves this big chunk, £1.5 million, which is our goodwill. So how do we figure out their tax relief? Don't worry, it's a pretty simple three-step process. First, we calculate that all-important cap. That's 6 times the IP value of £250,000, which works out to £1.5 million. Second, we compare this to the goodwill cost. In this case, they're exactly the same, so the full amount qualifies. And finally, we just apply that 75% rate, which gives Innovate LDN a massive annual tax deduction of £112,500.
And here it is, the number that really matters, the bottom line. With corporation tax at 25%, that deduction turns into a real cash saving of over £28,000 every single year. Now, for a growing startup like Innovate LDN, that's not just a number on a spreadsheet. That's a new developer, a big marketing campaign, or more R&D. This is why getting these rules right isn't just an accounting job, it's a powerful business strategy.
Okay, I know that was a lot to take in. So let's just boil it all down to the absolute essentials you need to walk away with today. All right, here's your pro tip checklist for the 2025/26 tax year. First, this relief only counts for goodwill bought after April 1st, 2019. Remember, the business you buy must have qualifying IP. The relief rate is a fixed 7.5% a year. And never ever forget that 6 times the IP value cap. It can really change your numbers. And finally, just be careful if you're buying from a related party, as there are still some restrictions there. So you can see the potential savings are huge, right? But you can also probably see that it's a bit of a minefield. So let's talk about the best way to move forward and make sure you get it right. Look, the rules around valuing IP, applying the cap, and structuring the deal correctly are incredibly nuanced. Get it right, and you could save your business a fortune, just like our example. Get it wrong, and, well, you could be in for a very uncomfortable chat with HMRC. The stakes are really high. This is absolutely where you need to bring in the pros. The team at My Tax Accountant live and breathe this stuff. They can guide you through the whole process and make sure your acquisition is structured to maximize your tax relief, all done properly and legally. Their details are on the screen, and I'd really recommend you check out their detailed article on this exact topic at the link shown.
And hey, if you found this breakdown useful and want to get your head around other complex tax and finance topics, make sure you subscribe to the channel. We're always putting out clear, simple guides for business owners just like you. And finally, just a very important bit of housekeeping. The information in this guide is for general educational purposes only. It is absolutely not a substitute for professional advice that's tailored to your unique business situation. Tax rules are complicated and they change, so before you make any financial decisions based on what you've heard today, you must consult with the qualified experts at My Tax Accountant.